information about the industry. I'm your host, Rocco, and I'm very excited to introduce my guest today. His name is EJ Attina, and he's the division manager at InterContinental Capital Group out of Melville, New York. EJ, welcome to the show.
Thanks, Rocco. Thanks for having me.
So why don't we start here? Let's start off by you just telling us a little bit about yourself. Give us a brief intro of who you are.
Been in the mortgage industry for about 7 years. Recently transferred over to Intercontinental Capital from Hartford Funding. We do everything in-house to, from FHA to conventional loans, VA loans, non-QM loans. I'm also a licensed realtor. I'm also an auctioneer for auction.com. So I'm always out on the streets talking to people and, finding deals that most realtors aren't really finding. You can hear my little guy in the background. Because of this coronavirus, the office is kind of shut down. So you guys are going to probably be hearing him in the background a little bit more.
Awesome. So you've been in the industry for 7 years, you said?
Yeah.
And what states are you licensed in?
We're licensed in 48 states. I'm licensed in only a few states, but we have company-wide, we have other people that are licensed in different states.
Awesome. So how did you get your start in the industry?
Believe it or not, my brother was my manager for a time being, and he's very smart when it comes to the mortgage industry. It's what he's been doing for his whole life, and he brought me in, and it's been pretty good since.
Okay, awesome. So did you do any type of work before you got into the industry?
Yeah, I was a personal trainer for about 15 years of my life, which was like cake work. Mortgages, not so much. I mean, it pays well, but anybody that could tell you that if they're in the mortgage industry with restrictions and certain guidelines that change per file, not every file is a cookie cutter file. So it's always a case by case scenario. Same thing with a client. Anytime that I brought in a client that, personal training wise, they may have an ailment, disability, whatever the case may be. It wasn't always a cookie cutter, like here's your, workout regimen, here's your diet regimen. It wasn't the same thing because not everybody is the same,
Exactly. Everyone's body is different. Funny
Completely.
story. The last guy I interviewed, Trevor, earlier today, he was a personal trainer before he got into the mortgage industry. So why'd you make the switch to the mortgage industry from being a personal trainer? Was it just primarily because your brother, or was there other
Yeah.
reasons? Your
A
brother?
little bit of both. A little bit of both. My brother wanted somebody that he could trust in the industry with him, so he brought me along the side of him. He said, what we could do is unbelievable, and believe it or not, what we've been able to achieve is pretty substantially unbelievable. It's not unbelievable. I mean, like if you know your guidelines, you know your loan programs, that's what really matters. It makes people's files move faster. It's typically when you have more of a hands-on approach towards a file. If you have that hands-on approach, you can move the file along and solve the problem if the problem arises. And there's always a hurdle. It's just how do you jump that hurdle? You know what I mean?
Exactly. So with what's going on in the market today, some crazy times, what is the best loan product on the market in your opinion?
In my opinion, it is a like I was just saying,
Yeah.
case by case scenario. When you take
Mhm.
into consideration low FICOs versus low LTVs, heavier down payments, purchase or refinance. Right now, most people are taking advantage of the lower interest rates and cashing out on the equity that they have in their properties. Average interest rate is somewhere around 3.5% to 4% for cash out on a primary residence. Investment properties is a little bit higher because obviously it's an investment property. Uh, FICO, credit score, I should say, that makes a huge difference also. Somebody with a 620 credit score versus somebody with a 720 credit score, there's a huge gap there. So there's a huge gap in pricing also where, some people may see a teaser rated for 3.125% and they don't technically qualify for that. And that's, you got to help navigate these people and help them understand these things. But honestly, the best loan program going right now, cashing out of the equity in your property. And then if you're purchasing, obviously there's loan programs out there that are amazing for purchases. Anything where are you located, Rocco? What city are you in?
Chicago.
Chicago. All right. So here in New York, because the taxes are a little high, depending on where your taxes are, real estate taxes, there's loan programs like this Fannie Mae loan program. It's called Home Ready. It's a great loan program. There is an income restriction, meaning you can't make more than $75,000 a year. Let's say that you make $45,000, but the house it's a high ranch and you can live upstairs and downstairs there's an apartment already there. Well, we understand the circumstances. You could qualify with the rental income from that apartment downstairs as long as it has a means of two exits, I should say, and a full kitchen and a full bathroom. We could help you use the rental income that you're going to be renting that off. Once you acquire the property, we're going to be helping you use 75% of that rental. So let's say that you get $2,000 for downstairs. You're going to get an additional $1,500 on top of your $45,000 annual income to help you qualify for this loan program. It's a great tool for purchasers, and you could do that on your first time or more than your first time home buyer. But then again, FHA and VA loans, you can't beat the interest rates on FHA and VA. There is a thing that comes with the FHA, though. There's the upfront mortgage insurance premium that always gets tacked on, kind of like the VA. There's a funding fee for VA. But with FHA, there's a monthly mortgage insurance premium. And that mortgage insurance premium, it kind of makes your mortgage payment a little heavier. See, with the VA, though, there is no monthly mortgage insurance premium, and that makes things a little bit easier on our veterans.
Yeah, for sure. So each loan product has their pros and cons, but you definitely have to look at the situation. You have to look at the circumstances, and then you can recommend one, like you said, no cookie cutter loan programs here.
Yeah, we have other loan programs, stated income loan programs. You need 25% down if your credit score is 700 or above. If your credit's below 700, then you're going to need a full 30% as a down payment plus closing costs. But this is, for seasonal people. Sometimes, like my landscaper, he XY, I'm not going to say his name, but he claims $45,000 a year in income. If you look at his bank statements, because he's seasonal, he made $200,000 last year. We used a bank statement program to help him qualify specifically off of his bank statements, his accounts receivable versus what he really showed the government. Amazing tools out there. Also, stated income. This one gentleman, he didn't want to state his income. He had the 25% to put down. He put the 25% down. He got himself a house. We stated his income to be, XYZ just for the loan. The reason why we're doing it this way versus, what we did 15 years ago, there's more skin in the game. Back in the day, you could put 5% down and have a stated income loan program. And when the housing market took a crash, that 5% wasn't a lot of leeway for somebody to sell that property on the market again and hedge and lose what they're losing. You know what I mean? Now with 25% down or 30% down, depending on what your credit score is, there's more investment into the game. So if we were to sell that property, let's say you stop making mortgage payments and we were to start the foreclosure process, just saying hypothetically, there's enough skin in the game where we can relist that property on a fire sale at 10% off of market value and still get out before any other issues. There's always a loan program for somebody out there, whether it be seasonal work or bank statements. They don't show a lot of money, or they're a cash business like a pizza parlor or a laundromat, where they're more cash than what they really show on the books. I mean, we have different loan programs for almost anybody, especially the stated income programs. They're amazing, but again, you have to have the income to qualify, and you have to have, well, I shouldn't say the income. You have to have the assets to qualify for that kind of a loan program. A lot of people they're tired of renting. They're tired of paying their landlord's mortgage, and they're looking to buy right now. And in Long Island, the scarcity of real estate is it's unbelievable. The property values are going up here. I don't know about in Chicago. I could probably run some analytics, but I know out here in Suffolk County, we're at 6+% annual. Nassau County, which is another county, Suffolk County, is 6+. Nassau County is around 5.25. Queens and Brooklyn, we're talking about higher ticket numbers. We're talking about properties that are easy $750,000 to $1 million for like a condo. But they're growing at a 2% ratio. A lot of people are taking the easy way of traveling a little bit further to Suffolk County, buying themselves for $500,000 a very nice house out here, and then traveling back and forth into Brooklyn for work on a regular basis. So that's the reason why you're seeing such an influx in the numbers here in Suffolk County and Nassau County versus Kings and Queens, which is, Brooklyn and Queens. Even Manhattan. Manhattan's never skipped a beat. Manhattan property values are starting to come up significantly stronger. It's turned from a buyer's market to a seller's market in Manhattan, where you could list your condo for, let's say, $2.2 million, and if it's really worth $2.2 million, somebody's going to give you $2.3 million for it. That's where the real estate is really starting to project. And it's a beautiful thing, I got to tell you. It really is. Me being a realtor, also selling foreclosures, REOs, and foreclosures on the back end, It gives me the opportunity to help service not just the people that have really nice houses, but the people that are looking for great deals. They want 70 cents on the dollar. That's, the market is there for that. There's no denying that. I mean, and it's a recession-proof market in my eyes because everybody's going to want a deal on a property. I, I think everybody would.
Absolutely. So how far are you from Long Island?
I am on Long Island, actually. I'm in Suffolk County. I live in Huntington.
So you're right next to Long Island?
I am Long Island. So Suffolk
Oh,
County, Melville is the
oh, okay.
borderline of Nassau and Suffolk County. So where our office is, our main headquarters is in Melville. Okay, it used to be in Manhattan, but now it's in Melville. But I live probably 25 minutes away, not even 15 minutes away from my office. It's very relatively close.
Do you know, so you're a realtor as well. Do you know a lot of Long Island realtors?
Yeah, quite a
Do you
few.
know Ala Quinta?
What's that?
Ala Quinta?
Sounds very familiar. Probably by face. Probably. I don't know if I've ever done a deal with them.
He's a UFC fighter. So that's
Okay.
the only reason I know. Yeah, Ala Quinta and Aljamain Sterling. I think he's a realtor as well in Long Island. But
Okay.
anyways, moving on. So you were a personal trainer. So obviously, when you help somebody to build muscle or lose weight, it made you feel good, right?
Yeah.
What would you say is the most fulfilling thing about your job in the mortgage industry? What makes you feel good? What makes it all worth it?
Passing over the keys on a purchase. I
Mm.
mean, anybody that refinances and saves money is great. A lot of my previous clients, I have a lot of referral clients that call me up and they're like, "Hey, what can you do for me now that the mortgage rates are starting to come down?" I'm taking them from, let's say, 17 years, putting them into a 15-year term, and their mortgage payment is relatively the same thing right now because of the decrease in the interest rate. So going
Mhm.
from, like, let's say, four and a quarter down to 3.5 on a 15-year, you're eliminating 2 3 years or some odd months. You add that against how much you're saving over the course of removing those years. It's just, it makes more dollars and cents than anything. It really does. So my favorite part, though, not just the refinance, is helping people save money if they want to go back to a 30-year, but tossing those keys, handing those keys over at the closing table is probably the best thing about the mortgage industry. It's giving people the financial freedom. Now the role is reversed. They're no longer paying rent. They own a piece of America, and that's like for some people that's the American dream to own a piece of property.
Absolutely.
Yeah.
So shifting gears here. So you started 7 years ago with your brother. What
Mhm.
were the biggest struggles or obstacles you faced, or you and your brother faced early on in your journey?
Equity in properties, appraisal issues. You would send somebody out thinking that the house was, and this was because, in the beginning, 7 years ago, 8 years ago, using tools like Zillow, which have a Zestimate, the Zestimate was not always accurate. Until you start to understand, how appraisers go out and reappraise a property, going off of a Zestimate was just putting us in a position where we were struggling because you would think that a house is worth $400,000, then the appraisal comes in at 375, and you don't have the equity to refinance, or there wasn't enough savings in it for you to refinance. So that was part of the hurdle. There were loan programs back then. One of the biggest loan programs was HARP, Homeowner Affordable Refinance Program, where if you were a Fannie Mae or a Freddie Mac loan, there were different qualifications. Fannie Mae would allow you to add as much of the closing costs back into the loan. Freddie Mac would restrict you to $5,000. Now, the cool thing was, even if you were upside down on your property, meaning you owed 400, but your house was really worth 350, they were still refinancing you regardless of what the equity share was in the property, and that was helping a lot of people that were at 5, 5.5, even 6.5. I remember one guy, Grata, he was at 6.5, and we brought him down to 4.5 as an interest rate. The guy was saving over $600 a month, and he stayed in the exact same term that he was in. He didn't have to go back to a 30-year term, which was like substantially happier for him because who wants to go back in term? I mean, you got 26 years remaining on your mortgage. Do you want to go back another 4 years to save a couple $100? Some people weigh it out, and sometimes it's worth it, and sometimes it's not. It all depends on, like we said, it's not cookie cutter. It all depends on a case by case scenario.
Yeah, that's amazing. You saved him $600 a month on his on his
It
mortgage?
was like it was like $612 a month. He stayed exactly where he was with the 26 years. He was at 6.5. He went down to 4.5. It was really good. It was a win-win for him, and that was like those are good days. Those are great days because obviously like nobody's better than you. You're helping somebody save $600 a month, and they're not going back in terms. So it was a win-win for him and us because it looked great on us.
Yeah, and that's the benefit with getting a lender who's experienced and knowledgeable. And just
Yeah.
talking with you here, you seem very, very knowledgeable since you're on the real estate side as well. Um, so moving on, what? So let's say we are 7 years and back in
Ahead.
time. What advice would you give to yourself or somebody in your position just starting out and hungry for business?
Um, Persistence. Knock on doors. I mean, your best form of marketing, even though it takes the most time out of your day, is knocking on a door because, especially right now with the coronavirus, everybody's like inside their houses. I mean, it would be the optimal time for somebody to go knock on a door and say, hey, look, interest rates have come down significantly. If you're higher than 4%, maybe we can offer you something that's a little bit lower and help you save more money, maybe accelerate your plan, put you a couple of years ahead of time and keep your mortgage payment relatively the same. There's so many benefits to refinancing. You get a couple of months off of your mortgage payment because servicing has to transfer. But giving advice and then an escrow refund, obviously, that's when it comes to like refinancing, purchases, same thing. I mean, right now would be the best time to actually put your feet to the street, knock on those doors, because that is like one of the best forms of marketing. I mean, you could throw out postcards, you could call people. They're getting robocalled every day, all day to begin with. They don't want to hear it. They want to hear what you have to offer, but they just don't want to be bothered by it on a regular basis, especially when they get home to their family. They just worked all day. It all depends on the time, but it's harder to close a door in somebody's face than it is to hang up a phone. I'll tell you that for certain. And that's any kind of advice I would give somebody. I would say literally knock on doors. See what you can do when you knock on doors and just say, hey, look, we're here offering, a free estimate as to what we can save you if you have a copy of your mortgage statement. Get a copy of the mortgage statement, do the numbers right there in front of them and say, hey, look, it either makes sense or it doesn't make sense. Leave them with some numbers and your card. And if they call you back, they call you back. Do a follow up. That's another thing. Follow ups. A lot of people, they don't really do a lot of the follow up. Nowadays, we have CRM systems. These CRM systems are great for leaving notes, sending out text messages, calling people, robo dialing. But again, if you're robo dialing and that person does not want to take your phone call, I mean, they're not going to take your phone call. They'll look at your text message, but they'll put their phone back down because they don't want to be bothered by it. That's why I always say knocking on a door is probably the best advice I would give somebody. 7 years ago, we hired people to knock on doors, and they made tremendous amount of money and strides in their career. Now they're licensed loan originators instead of just being door knockers. Now they realized, wow, this is what it takes. They know the key to success, and they're doing it on a regular basis, and that's the reason why they're successful like us.
Definitely, it's a good way to stand out because many people aren't willing to do it. And like you said, it's hard to close the door in someone's face when you're right there in front of them. Um,
It really is.
so let's go to the buyer side now. You're really knowledgeable in all these topics. So what do you see as the biggest misconception or fear that your clients have before working with you in regards to getting a loan?
Their credit getting dinged. If somebody pulls their credit, credit does get affected on a regular. If you're pulling it on a regular basis, if you're going out there and you're going to Macy's and TJ Maxx and you're opening up credit cards, of course they're pulling your credit and it's going to affect your credit score. It'll drop, but it will not drop significantly. The only time that your credit score significantly drops is when you make late payments or you over. I wouldn't say over withdraw, but I would say there's a ratio. And when it comes to credit, understanding credit, and I think tools like Credit Karma have helped out significantly by helping people understand these ratios. Let's say you have $1,000 credit limit on your credit card. Try to keep it below 30%. If you keep it below 30%, your credit score is going to go up because you're utilizing your credit in a smart manner. When it goes from 30 to 60%, it kind of streamlines. It doesn't go anywhere. It's just going to, if you're at 660, it's going to be at 660 for the next couple of months. Now, let's say that you're above 60% on your max allocation. That's where your credit score starts to drop. And a lot of people, they have a concern about this. Like, why is my credit not going anywhere? Well, let's look at your credit limits. You have $1,000 credit limit. You have $750 against it. Bring it down to $300 and watch where your credit score will boost. It boosts significantly. We also do credit rehab or rescoring. We tell people how to get your credit scores up, just like Credit Karma. But this was well before. We've been doing this for 5, 7 years before Credit Karma even came into play. Credit Karma is an amazing tool, I got to tell you. Sorry about that.
No problem. And
But go ahead. Sorry.
last question here. What is the number one most asked question you received from first-time home buyers?
What's my mortgage payment going to be? They really want to know where their mortgage payment is going to be due to the fact that they have a budget. You could approve them for $400,000, but let's say that the mortgage is $3,500 and they don't feel comfortable with the $3,500 mortgage payment, right? Then what you have to do is you have to educate them and show them, all right, well, if we found a house with taxes in this range instead of this range, because they're looking at taxes that are $14,000 a year versus a property that you could find with $8,000 a year in property taxes, that makes a huge difference in mortgage payment. A lot of people have a budget. I mean, great, we can afford a $500,000 house, but do we feel comfortable with with a $3,500 mortgage payment? So everybody's more concerned about where's my payment. Of course, you're going to get somebody, where's the rate? Obviously, most people are asking, what's the interest rate, because they hear that the interest rates that the Feds just lowered the interest rate even more. And that's I'm not going to say that I don't want people to get hyped up about like the Feds dropping, the Federal Reserve rates. There's still a prime rate and the bond is still exchanging at a certain ratio. Interest rates are great, but when it comes to the Federal Reserve lowering it, that's helping out people with short-term loans, like adjustable rate mortgages, 1 year, 3 year, 5 year adjustable rate mortgages. Those are the people that are going to benefit from those rates the most. People with long-term loans, like a 30-year or 20-year mortgage, obviously you'll see a decrease in mortgage rates, but it's not going to be as significant as you would with other loan programs that are available for you. Getting back to your question, I would say the first thing that, the one thing that I'm always answering is what's the mortgage payment, because everybody's concerned about, does this fit in my budget? Yeah.
Awesome. Well, EJ, I want to thank you so much for coming on today and sharing some knowledge with the viewers. It's been a pleasure talking with you. I really appreciate your time.
Yeah, no problem. Thank you, Rocco. I appreciate your time.
And thank you to all the listeners for tuning in, and we will see you next episode.
Have a great day, guys.